Hi, I'm Andrew Comstock with Beyond Wealth, and we are going to cover our third quarter 2020 U.S. Viewpoints, our quarterly review and outlook. This is the first time we're going to try a video format for this, so hopefully you like this. The third quarter of 2020 was another great one for stocks, and I'm going to share my screen. We're going to take a peek at them real quick. You can see across the board that stocks gained and rallied really well for the quarter. This is the second consecutive quarter that we had strong growth in almost all asset classes. This is making up after a really poor performance in the first quarter. You can look at the 2020 year-to-date performance, and you can see, generally speaking, most of the indices have recovered, from the lows and are positive for the year, but not all. And when we look at how things have kind of recovered off the lows, it's been pretty remarkable. This was the fastest bear market that we saw in U.S. history that we experienced in February and March of this year. And now we've seen the fastest recovery for stocks since then. If you look at the percentage off all-time highs here, you can see that earlier this summer, back in August, the NASDAQ, the S&P 500 and the Dow all reached those new all-time highs. And in the case of the S&P 500, this is the fastest we've recovered from the bottom back to the previous all-time highs ever, and we beat it by a wide margin. It only took about 126 trading days to regain that all-time high. The typical average we've seen going back to the 1920s has been 1,500. So we did it almost 10 times faster this go around. And 2020 continues to be a very unusual year for the markets and obviously for everything else going on. So how did we get there? Really this summer, we had a summer surge when it came to stocks. And when we talk about that, we're mainly going to talk about the large cap technology stocks. So the biggest 5 companies in the market, that's Apple, Microsoft, Alphabet, used to be called Google, Amazon, and Facebook. All of them had an amazing summer. And you can see Apple was up 41% in the period between July 1st and the end of August. The other ones were up between 10 and 20%. And these are the biggest companies. And so this is real dollars that were moving around. We also had a number of IPOs that came public this summer too, which helped kind of bring investors back into the market. We also saw a return of retail traders or individual investors coming back to the market. And this summer, they accounted for probably 20% of the market activity, according to Bloomberg. So that kind of helps explain why we saw things rally so much so much this summer. Now in September, if we go back to our first slide, you can see there was a pullback in stocks. And that was actually something that we think was pretty welcome for a number of reasons. The first one had something to do with politics, and that is that there wasn't a second stimulus bill out of the US Congress. So I think investors and the market were definitely expecting to see something happen in September. They didn't get it. So that was naturally one reason we saw a pullback. The other was that technology shares kind of just sold off a little bit. So still did very, very well for the quarter, but it was good to see them cool off a little bit. They probably got a little ahead of themselves this summer. Stop sharing my screen, and we're going to kind of go back to just talking about kind of the rest of 2020. And the biggest thing that people are probably focusing on, that's the elephant in the room, that's the election. So every meeting we have, the election comes up in one form or another. And, we expect the election to be contentious. We don't expect to have all the results on election day. I think that is table stakes at this point. The market is echoing that. And what we mean by that is when we look at volatility in the market, and you can buy or invest in volatility, believe it or not, they're pricing in excess volatility or above average volatility through the end of the calendar year of 2020, and they're seeing it normalize back to regular levels in January of 2021. So that tells us is that the market is pricing in some election uncertainty, all the way through the rest of this year. So they're not just expecting it through election day, but through the full calendar year. So the market's pricing a lot of this stuff in. Now, we are looking past the election in terms of our investment decisions right now. We don't feel like we have an edge in terms of gaining any kind of opportunity necessarily by placing a bet prior to the election. And so we feel comfortable that 2021 is going to be a great year for the economy and a good year or a great year for corporate earnings. That's what we're focusing in on. The one thing we will tell you from a history lesson is after the election, 90 days out, markets are generally higher. 75% of the time, you see markets above the previous level, or above that pre-election day price, and the average rate of return is about 3.7%. So that's a pretty good indication to us that once we get certainty from the election, investors start to move on, and they start to go back to maybe their normal trading activity. The other thing we'll talk about now is just kind of our general outlook. And when we talk about our outlook, the first thing we're going to talk about is the Federal Reserve. So the central bank here in the US gave two pretty big pieces of information to us during the quarter. Number one, they have no intention of raising interest rates until calendar year 2023. So we have 2.5, 3 years of forward guidance from the Federal Reserve saying they're not raising rates. The other thing we got from them was they're changing the way they look at inflation. In the past, when we got to about 2% inflation, they would start taking activities to calm the economy down a little bit, raising interest rates just to kind of manage that number. They've said they're going to let inflation go a little bit longer. So what does this mean for you? So as a stock investor, this bodes very well for stocks. And the thought process is twofold. Number one is if interest rates, we have clarity that interest rates will likely remain low or lower than historical averages for a while, that usually means that the best alternative is going to be the stock market. The other thing that we can expect is that we can get higher valuations because of for stocks and for the entire market because of the lower interest rate level that we're seeing. Both of those things are very favorable for stock investors. Now we'll shift to kind of economic growth and to corporate earnings. So, most of the economic trends we see are pretty favorable, and everything is kind of trending upwards. That's a very, very good thing. Expectations have moderated a little bit just based on some stuff we've had come through in September. But generally speaking, if you look at the trend, it is improving across the board. Now, we know it's not going to be a smooth ride, and we'll get into that in a second. On the corporate earnings front, we expect that 2021 will look like 2019 or better on the corporate earnings front, and that's a positive. That would mean we have about a 40 or 50% earnings growth rate from calendar year 2020 to 2021. And obviously, we have had depressed levels this year because of COVID, but that's still a very, very good sign. In 2022, if we want to go out even further, starts to look optimistic again. Now, market is a little bit at the higher end of its normal valuations at about 20 times forward earnings. That's using 2021 earnings. But it's understandable given that interest rates are low and that this is somewhat of a trough period for the economy and that things will get better moving forward. Now, we're not, just all Pollyannas. We understand that there are some risks out there. Obviously COVID, we haven't really talked about it much during this entire video, but it's something that's out there. The risk of a second wave is real, and it's not going to be a smooth process. We know that there's going to be, changes towards how we can go out and shop, how we can go out and eat, how we can go out, whether our kids can go to school and things like that. So we know that this is not going to be a smooth ride or predictable, but we know that the trends, though, are improving across the board in terms of the economy. The other thing that I also want to make a comment on was something I mentioned earlier, and that's retail investors. And generally speaking, when retail investors enter the market, it can be a signal that we have reached maybe a market peak. Now, this situation, the circumstances are a little bit unique. Retail investors kind of came back into the market during the March and April lows that we saw earlier this year. So they weren't really jumping in or surging in necessarily at a market peak. The other thing we're seeing is, in 1999, I think that's what the reference point a lot of people are looking back to is you had a lot of people quit their jobs and become day traders. That's not happening this go around. Most people are using the stock market as a replacement for fantasy sports when they were not around as much this summer. And, that's typically what we're seeing with people, how they're treating their retail or their individual Robinhood accounts and stuff like that. So while this is something we're monitoring, it's not something that think is a market peak or a market top event. But we are kind of monitoring that, and we'll continue to talk about that probably in coming quarters. We'll just kind of wrap up with this is that, we know this election season is going to be very contentious. It's going to be emotional, but we're looking through the election and we're focusing really on the long term, and we're optimistic that stocks are going to continue to perform well over the coming year and over the long term. And anytime we see weakness in the market, if we get a sell-off prior to the election, we'll probably put some of our cash to work that we've got sitting on the sidelines right now. So wrapping things up, we are positive about the stock market moving forward for the next 12 months and longer term. We do expect things to be noisy in and around the election, but not really changing our stance or our investment strategy because of the election right now. So thank you very much for your time today. If you have any questions, feel free to reach out, and we look forward to talking to you soon.